Bevan, Brent, come on stage. Tell us all about refining the business value propositions, aligning processes, all that stuff. We've talked a bit about the grunt, what makes it work. This is a bit more around the advisor practice side of things. So, Bevan, over to you.
Thanks very much, guys, for having me. I'm aware it's straight after morning tea, and I've probably got about 20 minutes before that sugar kicks in and everybody's going to want to have a nap, right? So I'll get through this as quickly as we can. So today's presentation, the title's a little bit aloof, but the context will become apparent very quickly. So just bear with me on that. Let's just get through the formalities, disclaimers. Everybody else had one. If I didn't have one today, I'd be jealous. So we've got one. We know the content here is clearly aimed at financial professionals. That's all it's relevant to, and that's what it's intended for. So let's get straight into the content. Now, if we're talking about journeys and managed accounts, we had a pretty good session this morning where the presenters touched on some pretty key issues, and what we really wanted to do today was to expand on some of those issues and get into the weeds a little bit, and hopefully you can walk away with some practical examples of the things in this instance that you want to avoid on a managed account journey. So let's set the context very quickly in terms of this whole journey roadmap theme, and look at what it actually looks like on an end-to-end basis, right? Pretty simple. You start with the idea phase. Now, that could be something like today, attending these conferences. You could be talking to consultants or asset managers like us. You could be talking to your platform. Bottom line is, whatever it was that generated that interest in understanding exactly what a managed account can do, and as we heard this morning as well, the clear, tangible benefits that it can provide at a practice and client level. You've got that in your mind. You find very quickly that advisors and practices then move into that solution mode. Right, I want to start talking to providers. I want to start talking to platform providers as well. How do we get this thing going? How's it going to fit my practice? And how do I get to a launch date? And in theory, if you've done all that well, you spend the next kind of 12, 18, 24 months transitioning all your clients, and then we get to this utopia destination, which is effectively my entire practice is now transitioned, or the majority of it, to a very high quality, efficient, consistent, and scalable investment solution. Great. And I think, largely that is kind of being achieved, and that's why we're seeing the kind of FUM and flow numbers that all of the presenters get up here and talk about now in terms of the extraordinary growth. But what was also touched on this morning is there's a few factors that can actually, impede that. And on this whole theme of, roadmaps and journeys, we thought you can roughly categorize those into three categories. One being speed bumps, right? And these are the things that pop up after you've gone through this extensive build-up process that slow down the take-up within your firm, but don't necessarily derail anything. They're just little hiccups, but if you get enough of them, then you end up with this transition process taking far longer than you want to. There's another group of issues that we would kind of categorize as detours, which is where you actually come to a decision point in the practice, and that's either you as an advisor or the advisors working under you or as a licensee, all of those advice practices, and you've got an opportunity to kind of deviate from the course. And if you do those things, then the transition plan ends up taking far longer than you thought. And then we get to the big ones, which are really just the roadblocks. And these are the examples, and you can go away and talk to any of your platforms about this if you wanted to. How do you end up in a position where you've spent months of time and effort, maybe even money, building out a managed account process, you've got it on platform, and 12 or 18 months later, it's achieved 10, 20, 30% of the growth that you thought it was going to achieve? That you thought you were going to have 50, 60% of your client base there, but there's only 10 or 20%. What went wrong? And what we want to explore today is some of the things in both our experience and those of our platform partners that really kind of cause those types of issues. So just to improve the context that we go through this, I think it's really important that we start back on this whole build process, because in fairness, this is kind of where most of these problems kind of come from. So I won't go through the full detail of this, but what I'm trying to present here basically is what I would see as a fairly standard roadmap for how you would go out about the kind of selection build-out process. Now, this is the type of process that, say, MLC would follow when you're trying to build a managed account largely from scratch. So if I said on the complexity scale of 1 to 4, this is kind of a 3. All right, and I think that's a good place to start because at least it gives you quite a bit of detail. Rather than going through all these dot points one by one, which I'm happy to talk about afterwards, there's 2 key points I want to call out on this. One is this is pretty standard, but what you'll find is almost all of those points, this is so secret they've got to close the windows, All of these points are focused on pretty much the investment design and the investment implementation. Sure, all the things that get investment consultants like me excited, but the reality of that is these aren't really the areas where the problems arise. This is pretty standard affair, and any good quality consultant should be able to build this, and that's because there's a few components missing from this process. The first one, which was kind of also gone through this morning, is any good process needs to start with this, right? Understanding your practice and understanding all these key points, right? What are your types of clients? What's your advice model as a business, right? What's your current approach to investment? And we might know that just by looking at the portfolios, but then we get into these questions of, well, do you have an investment philosophy? Do you have investment beliefs? We see from the research from most of the platforms, those who haven't started their managed account journey yet, the answer to that is kind of no a lot of the times. And that's not a bad thing because, sitting down and writing the 10 commandments from scratch actually isn't all that easy, right? And we know it, and that's why we kind of avoid it. What are the key drivers behind you actually wanting to take on a managed account? Now, we might assume it's because, yes, we want the efficiency, and yes, I want a better client experience and those types of things, but that's not necessarily always the primary driver. And if you haven't nailed that down, then that's when you get some issues later on in the process. Only once you understand those things can you then get to that last point is, do I even know if I'm working with the right provider here? Right? Do our philosophies match? They don't need to perfectly align, but they need to be fairly close. Because it's going to be pretty hard, if you're dealing, effectively with two separate churches and you're trying to bring them together, right? You need to be pretty close to each other, and if you're not, again, you see problems down the line. One point I'd call out there is that answering those questions is very hard if you haven't thought about them in the that initial kind of idea phase. That's really the point where you're not just thinking about, what can managed accounts do for me as a practice and how would I get there and who would I select, but it's really thinking about those things that were brought up this morning. What's that do to my value proposition, and do I have an investment philosophy, and how do I actually want to run these things? That all needs to happen at the idea phase, or at the very least, bringing on that consultant that can say, before you talk to me about investment portfolios and MERs and targets, you need to be talking to me about this kind of content. And then there's a whole other body of work which basically has nothing to do really with the investment side, and that's the advice transition piece. What about advice systems? When I build this thing, is it even going to filter through to X-Plan the way that I want it to do, right? What's the wording going to be? All these things which, again, to consultants that have maybe spent a long time in the institutional investment world, these are completely unknown artifacts in the process, right? What about my advice documents and my SOAs? Sure, I can generate some generic SOA text, but almost everyone in this office has a completely different SOA template depending on who your licensee is. And how useful is that generic text going to be? Probably not all that useful for a proper transition plan. And then there's things like segmentation planning and communications and all those types of things. So, we think this probably represents a clearer roadmap, and those sections in the blue, that's where you start to get these speed bumps, detours, and kind of roadblocks. So let's launch straight into that, shall we? Speed bumps, the easy ones. So a couple of things that we see obviously at an MLC level, but also we hear consistently from platforms, and that I've also been through consistently myself in my many years in licensee land. So things that slow progress to transition, but it's okay. You can overcome them, and you normally do so reasonably quickly. One is client segmentation. Right, so the first thing we see there is you might have some practices that have a very good client segmentation model that they kind of operate, but the question there is, does it need to continue to operate like that under the managed account space? And what we see there is just practices trying to segment their clients in too complex a manner, and also still focusing on things like FUA or pure servicing level to figure out whether or not a client is going to be appropriate for a managed account, and we're not sure that's really the process you need to do. Operational detail is another one. Now, we're all guilty of this. I've come from a fund manager, and we have a great library of fantastic flashy brochures, as does every platform. But what you need to do as an advisor, and as we know, is what's the operational level detail here, right? The devil is in the detail when we get in. When my paraplanner jumps in and actually finds out the functionality isn't as good as we thought it was, right? That the communication wasn't quite where it needed to be. All those little things, they represent tiny little speed bumps that kind of slow down that progress, right? It piece by piece kind of strips away the initial excitement you might have had about rolling this out. And they're things that we find, there's not a huge focus on because you're normally focusing on the big ticket items, the exciting pieces that are in the brochures that are going to be transformational, rather than those little, kind of niggling gremlins in the system. And then there's just a piece around change overload, right? Because for some practices, this transition to managed account piece, you're talking about transforming your investment philosophy and beliefs. You know, you're talking about upgrading or changing your value proposition. You're potentially talking about a platform switch, also a change in investment process, and then that means, you know, potentially dramatic changes to underlying client portfolios to actually do that transition. That's a lot of work, and I think all of us in the room can understand that, and it's thinking about how many of those things actually really need to happen and why they're kind of happening. So we've got some issues there which you think can come up. You know, what would be some of the ways that we would suggest kind of looking at them, you know, so that you can overcome them and make sure that you're not, you know, exposed to them either while you're on this journey or if you're thinking about doing this. So the first thing is around the client segmentation is linking that to service offer review. I don't really necessarily see, you know, many practices or a world where, you know, you can whole as bolus transfer to a managed account type operation and not think about what your advice service proposition is going to be. You know, those two just go hand in hand. And what I think, you know, suggest there is rethink the old segmenting piece. Are you actually embracing the scale that comes with managed accounts? Now, there was, you know, a fact that come up this morning with, you know, Paramium saying, what's the minimum balance that we're seeing advisors use managed accounts with? Once upon a time, and we still hear this a lot, well, look, you know, I've got my clients here, you know, I think they're mostly in multis, and then, you know, between kind of the 2 to 500,000 mark, they're in a different portfolio. It's only the $500,000 plus clients that are in managed accounts. Well, that's A, dramatically changed, and B, doesn't necessarily need to be the case anymore. The scale that managed accounts gives you is there is no reason, pending the complexity of the managed account, of course, that you cannot have a client that's got $100,000 in the same managed account with a client that has $2 million. And the other piece I'd note there too is you're also seeing a lot of high net worth firms do similar things, right? So these are firms where you would think traditionally they would have the argument to say, oh no, like that kind of systemized, you know, investment process just will not work for my clients because it's very customized. And you're still seeing clients that have got $2, $3, $4, $5 million balances in programs like this. So we definitely encourage you to think beyond that, and does that allow you to simplify the segmenting within your business? Operational detail, yeah, sorry, there's probably no real way around this one. You've got to do the due diligence, right? And it's hard because there's not a lot of that kind of due diligence available for you, but really getting some ability to get in and find those gremlins. You know, if your provider can even be honest with you, right? These are things we're working on, these are issues, but at least if you know about them, right, they're not going to be things that are going to trip up the team, you know, or slow down that progress for you. And the only way to do that really is either talk to the platforms and managers. If you're not talking to them, then talk to other people that are using it, because, you know, frankly, they're probably going to give you the feedback that you need to hear. And even though we can give very honest feedback about how we run these things, obviously, from an investment management perspective, we only see our portion of the platform. Right? We don't see the portion that you get to use, and we don't see the portion that the client gets to use. And arguably, they're probably the far more important aspects than the side of the platform that we need to use, right? And as long as we've got our spreadsheets and our Bloomberg, we can probably do what we need to do. It's the other side that's more important for you. And the change overload, look, depending on the level of transformation that's going to be in the practice, that's obviously pretty hard to avoid, right? So you just need to make sure that you know, the advisors and the support staff in your business are comfortable with that and kind of understand what they're doing. Try to minimize it where possible, or stage these things over time. There's no kind of simple solution to that one. And then the other pretty obvious one is, you know, can you test batch this first, right? I think that's pretty straightforward. Most advisors will try to do that. You're not going to come and take, you know, your top 20 star clients and all try and execute that, you know, within a short period of time. You need to give yourself a runway to play this through so you can work out your own kinks in your own process. So the next ones get a little bit more complex because you would think that the roadblock side of it is the more dangerous one, but in some cases this detour path is actually the worst one that you can kind of run across in terms of this transition. Because what it does is it introduces kind of tangent routes and processes in your business. So if you think about that, a very simple example is you might go, look, we were a wholly reasonably systemized model portfolio type business. Then we picked that up and we tried to transition that to managed accounts. But for a few of these reasons, that transition didn't go to plan. So what we've now ended up with is kind of half model portfolios and half managed accounts. So we've actually just introduced additional inefficiency into our business because now we're running concurrent processes that we didn't really want to do for a much longer time frame than we thought we were going to do it. Lack of transition planning is probably the biggest one that causes this particular issue. Right, and in our experience, you know, there's a few things that can cause it, but two of the big ones come down to either moving from your current state to the end state far too quickly. right? So you've got an existing model and what you're running, you've partnered with somebody, but the end product, or solution that's been engineered is very, very different to what you have, and you're having to turn over 70, 80, 90% of your portfolio to try and get there, plus a platform switch, those type of things. If you're the principal single advisor, you might be able to work through that. But if you're the principal or partners of a larger firm or a licensee, trying to convince everybody else to go on that journey, a lot harder, and that's when you're going to look at it in 12 months and go, we're nowhere near where we thought we wanted to be. And the other piece too is embedding too many compromises in day one in terms of building this program, and we'll talk about what some of those might be. Number 2, client hoarding. Wasn't really a nicer way to say this, but that's effectively what it is. And this is particularly relevant, as I said, to advisory firms that might be building this at a principal level and then trying to roll it out to a large group of advisors, or to licensees. Because if you've got advisors who aren't on this journey, like anything, we seek the path of least resistance, and you're going to find that there are some that are going to look for reasons not to be rolling this out. Oh, no, not that client, they wouldn't like it. No, not this one, I need to keep control of that one. And loss of control is one of the biggest reasons that's thrown up for that. This is the cohort of clients that I still have to control the investment decisions for, and then you get to the end of what should have been a transformation progress, and you go, well, hang on, you've only moved half the clients that you thought you were going to move. That kind of defeats the purpose. And all those nice numbers that we had up there from the platform provider around the efficiency we're not going to execute any of those. And the other thing is, it's not linear too, guys. So just because you transition half the clients doesn't mean you get half the scale benefits, right? It doesn't quite work that way, right? Moving half of it means you probably only captured 10 or 20. You need to get to that critical mass to actually be achieving those efficiency outcomes and those improvements in communication and those client experience benefits. You need to get to critical mass in order to achieve that. Then there's the market timing one. This one's pretty related to number 2, but we still hear it a lot, right? Which is, again, that finding reasons not to necessarily do it. Now might be a perfect market environment to see this. Yeah, look, this would work for this client, but just look, not right now. Don't want to sell that asset. We'll move them in next review. And of course, if you're on a 12-month review cycle, all of a sudden that 18-month, 24-month transition plan becomes 3 to 4 years before you know it. So we really need to be thinking about why would we be doing that. Lack of transition planning, pretty simple. You've got to think about that in the build-out phase. That first part of that progress chart I was showing you there, that's what it does. The quality kind of consultants and providers will pay a lot of attention and effort to helping you kind of do that, and you kind of heard that on the stage from 2 very experienced providers in Zenith and Lonsec around that. All of us are pretty critically focused on that as an area, because even if you're a fantastic investor, if you don't get that part of it right, your practices are going to struggle. Then it's thinking about what drove the portfolio and platform changes. So this is this piece around embedding compromises and moving too quickly. Were those changes genuinely driven by what you think is a good future state portfolio? Were they heavily driven by your consultant convincing you that that's what you needed to move to? Or were you trying to meet a fee budget aggressively? And what you ended up doing is having to strip parts out of your portfolio that now means the value proposition of that becomes a bit more challenging. Not for all clients necessarily, but the main point there is when you need to put pen to paper in the bid section of your SOA, how easy is it for you to actually list those points out? And if you've compromised too many things, you start going, okay, that's a bit harder. And then do you leave yourself open to other providers who are then going, well, look, our service proposition here has all these things and it charges the same fee. We think this is inferior, right? So, what looks good as a fee target to begin with can often end in tears. And that's what I've said here around it presents challenges with bid, with your value proposition, and then even addressing client objections. And for some firms, that won't be a problem because you've got the client bases where, look, whatever you say, we're going to go with. And then, but of course, always know there's a cohort of clients that are going to scrutinise what you're saying and what you're doing, and you don't want to be in a position where you're not really believing, what it is you're putting out there versus what you'd already built in your business for 10 years. The client hoarding piece, that's pure behaviour and culture. I don't think there's anybody in here who hasn't done some form of behavioural finance training. That's great. Doesn't matter how much of it we do it. All the training tells you that we're still going to be susceptible to it, right? Just knowing about it isn't enough to overcome those behavioural biases. So really, we just have to be thinking about what's driving those behavioural biases, right? Of course, there are some value propositions where doing the advice and doing the investment is my value proposition, right? So therefore, some sort of a systemised managed account program, whether it be an SMA or MDA, is going to be very challenging for those advisors. But for the most part, it's maybe just that they they don't feel comfortable with the process, don't understand it enough, aren't really comfortable with the value proposition. So that's where some effort needs to be channeled to make sure that that doesn't become an impediment within your business. And the point I'd make there is those ones can very quickly go from detours with small amounts of clients which they decide to hold to becoming a full roadblock where you might have a practice with 7 advisors and you go, well, 4 of my advisors have literally gone and taken the detour route with 7 out of 10 clients that they were supposed to be advising. And the market timing, that's really the same factors as above. We often hear some things around kind of, the sunk cost investments. Look, there's a couple of funds there that we had, didn't do quite well, but I'd prefer not to liquidate them. I want them to come good. Now, that's either something that you're building into the managed account program that you're buying, or you need to be thinking about, well, what is it that I'm waiting to come good? Is it manager alpha kind of mean reversion? Okay, that one might be a bit questionable. Or is it just the underlying asset exposures? And therefore you can actually demonstrate that, well, actually I've got the similar exposures within the new portfolio we're transitioning to anyway. So it doesn't really matter, give or take the buy-sell cost, and maybe we're doing some tax loss harvesting. So it's not as big an issue as we thought it would be. Then we get to some of the ones which are roadblocks. And there's a few here to kind of get through, right? And these are really ones that present significant delays or risks to a managed account being implemented. And these are the ones where we do see, months and months and months spent on building a managed account program. It's sitting there, it's ready to go on platform, and it's just not being used. And there's probably not, any consultant around the room or platform here that won't tell you that there are some of those, sitting on their books. And I'd say, licensees at a level are particularly susceptible to this particular issue because, you're to a degree building them up at a head office level, and then the convincing of the users of that kind of comes later, and maybe that convincing just doesn't occur. So number one we would say there is bid. Bid. Everything kind of is a big challenge when it comes to this. The too many compromises route, that's a challenge for bid. Too much focus on the advisor practice outcomes versus the client outcomes. And that's not necessarily your fault, but I'd say, even the content here, if we look at it today, most of the managed account literature is very heavily skewed towards practice, advisor, efficiency, profitability per head, scalability, all that. They're all great, and that makes sense because it's the group it's pitching to. But you can't copy and paste any of that into a client SOA. Right? None of that is necessarily relevant to a client. So, there needs to be that strong focus on what are the client outcomes here, how can I articulate that? That comes up 90% of the time, as a problem. And the only point I'd kind of make there is if you think about a traditional kind of model portfolio framework, apart from some limited circumstances, I can imagine, it's not that hard to envisage how the increased transactional efficiency, the consistency of which the investment decisions are being made, the quality of the communication, the ability of advisor to spend more time in terms of, strategic advice with that particular client, adding all those together, as long as the cost isn't excessive, I can see where that argument lies necessarily that that's not bid versus the very traditional kind of model portfolio. We'll sit down, look at it, maybe review it, once a year type of exercise. But that comes down to this piece around articulating cost versus value. And having spent a lot of time in licensee land myself, I'll happily admit that most licensees aren't very good at this. Right? It's not their fault. It's because of the compliance regime we come for, particularly with bid. You're trying to pass these audits. You're trying to do what you do in this sector. So what do? You just divert to the one thing that's quantifiable, and you go cost. And I'm sure there's probably a few of you in the room here who've had robust discussions with somebody from a compliance team or a compliance auditor who's saying, "Oh, I don't think that meets bid." And you go, I don't think you're looking at the whole picture here to go through. But that's because we live in a world where, compliance checklists are still the most simple way to kind of get through 1,000 file audits. That becomes a problem. But if you're not very clear yourself in exactly what that cost-benefit analysis is, it's going to be very hard. Convincing the client's one thing, but convincing, compliance auditor and your paraplanning team might be a whole other, kind of adventure. Advisor value proposition. Fundamentally, do managed accounts improve or compromise your value proposition? Now, I would say if it's the latter, we're probably not even on this journey, right? If it's the latter, you probably think about it and you kill the managed account idea very quickly. But still, if that value proposition isn't honed very well, that's where you kind of get down the track and you go, yeah, actually, maybe I wasn't able to convert as many clients as I thought I could. And we look at that and go, that's a problem that could be solved, up front. Underestimating the cultural change, that's similar to what we discussed just before. Yes, particularly if it's something you're building again at a licensee or you're building at a principal level, you're heavily involved in that process. But the rest of the people in the business aren't necessarily. So they don't have maybe the level of conviction and buy-in and the cultural change that's required just to move that along. Underestimating that will definitely slow down the process. Failure to meet expectations, that's a pretty simple one. Any kind of new endeavour where you're taking on this, whether it be a new investment consultant, a new platform, if you get some way down the process and it's not delivering in terms of the communication, the performance, the service levels, clearly that is going to stop both you and other advisors kind of, or at least giving them pause to think about, do they want to convert that next client into it? So being able to address these is very critical. Performance and service levels, that's pretty straightforward. The other interesting one there that we're probably starting to see a bit more is the consultant mismatch. Right? In reality, in terms of financial services, this is a fairly new and growing area. And if we think about the weight of money that has come into the managed account space, most of that is in the last 2 to 3 years. Right? Managed accounts have been around for a decade plus, but most of that was kind of single asset, and the real exponential growth is now. So it's only after that first kind of 1, 2 to 3, let's call it the honeymoon period, that now we're starting to see, was I actually really aligned, right? Did the platform actually deliver what I thought it was going to deliver? Is my consultant and my firm getting along like I thought they would? They're the things that are kind of starting to come up now, and we'd say unwinding those at that stage, although managed accounts certainly gives you that ability, because effectively now as advisors, you're all institutional investors and you have the ability to terminate a mandate and move it to another provider. But that's another process that you're going to have to manage, and it will definitely slow down the successful transition of your practice to managed accounts. And the last one there is licensee requirements. So for any of you in the room as self-licensed, obviously you don't have to worry about that because in your business, you are God and you control those rules, right? To an extent. But for those of you who are the licensees, we've actually seen multiple times where advisors have come to functions like this, obviously understand the benefit to the business, interviewed multiple consultants, gone about building a proposal, literally spent kind of months on this work, and then turned up to the licensee and said, great, we want to do this. And we take one guess at what the licensee said to them. Right? No, and so it seems a bit nonsensical of going, why? Like, if it was a fund, the first question you would have asked is this on the APL? Right, but in the managed account space, we actually don't see that, right? And so, therefore, the experience for both the licensee and the advisor very poor in that situation, right? You wouldn't think it'd have to be on the list, but it is. So big challenges. What can I suggest there, right? Any kind of major compromises you're making in the design of these things is ultimately going to end up in long-term challenges for the sustainability of that managed account and your ability to sell that across your client base. Focusing on what is being gained, not just what it's costing, right? And again, as I said, I don't think that's necessarily the advisor issue, but the compliance frameworks we have kind of force us into that mode sometimes, and that's where you really need to have a solid understanding of your licensee view. This, and I can say myself, when we were rolling these things out at a licensee level, we're going right down to the detail of going, show me the SOA. Like, I actually want to see the sections where, as an advisor, you're going to have to articulate these benefits. Show me the product replacement section so we know what's going to go in there. Show me the licensee standard. I want to know exactly what your compliance auditor is going to be looking for on their 7 checklists to say whether or not I think this is bid, and we need to make sure that whatever it is that's being built is going to meet that. And it's not that we think that it's not going to meet it, but it's just about being sure that you can articulate it in the way that that file is going to be picked up and give the tick and move on. Because we know if it's not, between the advisors, paraplanning, it's just a nightmare, right? Advisor value proposition. Lots of content out there on how to kind of look at these things. One thing I would say here, we get a lot of objections kind of around, the structure's too rigid. A lot of my clients are customized. I could never use a structure like this. I gave you the example before of a lot of high net worth and even family office type firms who still use these structures, right? Because they want consistency in approach. They still want the scalability. They don't want to have their clients all having disparate investment experiences. They still want that. There is a lot of flexibility in these structures. SMA between MDA, you don't have to go the whole MDA piece. There is SMAs being used within an MDA structure where you want the core of the investment to be fairly consistent, but you still want the flexibility to manage those tax aspects or manage your liquidity or some other things with clients. Those structures exist, but we see with a lot of advisors, they just assume it's going to be a one-fits-all, size-fits-all approach, and therefore they kind of discount the whole thing. And what I'd say there around the value proposition piece is, unless you have a very specialist or niche kind of firm, don't try and reinvent the wheel here. It's very similar to the investment philosophy piece, right? What's the chances you're going to write down an investment philosophy that is completely materially different to the other plethora of institutional investors that are out there at the moment? No, we've all got similar principles. So seek out some of those firms that might be similar to you. Your platform providers, your consultants can help you with this and going, there's already a similar firm with a similar client base who asked the exact same questions that you're now asking 2 years ago. And this is what they did and this is what they wrote. And maybe that's kind of similar. I don't feel that you need to invent all this stuff yourself. The cultural change, obviously, that needs to be specifically managed. Get buy-in if you can, beyond key stakeholders, right? So if you can get it down to that paraplanner level and that would be great. Failure to meet expectations, look, no way around that one. You've got to do the DD, right? What's your tender process when you're looking at these consultants? If you're buying a managed fund, right, you've got a whole world of managed fund research that's available to you out there. But when you get into the managed account space, it's very opaque, right? You can't just jump onto a Lonsec and a Morningstar and get a rating for the people you're going to be talking to. So the DD process is a lot more involved. Think about what you actually want out of the partnership and then talk to the consultants and platforms about what they actually think their weaknesses are, just not what they think they're great at. And the licensee requirements, it's very easy, ask. You need to be engaging with the licensee day one, right? What's their attitude? What kind of guardrails are they going to give you? Because that one could just literally kill the process dead. So I'm right on time, guys, but very quickly, the key takeaways here, for us is what are the biggest potential obstacles, okay? We've got a few there. Not evolving the value proposition, not getting the transition right, a bid focus that's too narrow. We're forced into not thinking like advisors, but thinking like compliance auditors. And at the end of the day, partnering with the wrong consultant and the wrong platform and underestimating that cultural change. How do you avoid it? Well, in that whole process of things we need to do, know that they're the key things you need to kind of be focusing on. Make sure that you build it out specifically in your program of how are we going to fix these things if we think they're going to arise. Make sure you have a quality due diligence process and some sort of tender process around the way you do this, just like you would any other provider in your business. And seek external advice and experience. Right? There's a plethora of consultants, and I'll say this, the plug for the platforms here, these guys see it all the time, right? So they can give you advice on what has worked and what's not, and what are the providers that they get, have worked well with or get good feedback on. Can you get roadmaps so you don't have to listen to people like me talk about this? Yes, you can. There's plenty out there. They're quite complex, so they tend to be broken down into a few different categories, right? The why, the what, the how, and the who. Right, so we have papers that pretty much cover most of that, and the platforms also have libraries of podcasts and great quality white papers for every kind of step in that journey to think about. Review that stuff so you don't go into it blind. And where can you find help? First one I'd say is licensee. Again, not because I think that the licensee is going to have all this information on hand, but simply because they should be the first one you're talking to set those expectations and set those guardrails for where you should be looking to begin with. If you've got an existing consultant or fund manager that you've got a great relationship with, excellent. Start right there. But that doesn't necessarily mean that you don't then subject them to some form of DD or tender process as well, right? It would only be fair. Platform providers, as I've already done, you'd think I work for a platform provider. I've been plugging them all day, but they have some great content on this. And at the end of the day, Google can be your friend here. The only thing I'd say is that, a lot of it is focused on the advisor end and not necessarily in articulating the kind of client end. So that's probably where we need to do a little more work. And that's for me today, guys. I appreciate we covered a lot of content, and it's pretty much the end of financial year. So I'm very impressed to have you guys lending us your time here at the table. So thanks very much.
Awesome, thank you.